If a meteorologist perfectly predicted the last devastating hurricane.
They probably listen to them.
Right, exactly. Like, even if they're calling for some Category 5 blizzard that you absolutely do not want to hear about, you owe it to yourself to at least look at the radar.
Oh, 100%. You have to look.
And that's exactly what we're doing in today's deep dive. Today is June 12, 2026. Bitcoin is sitting exactly at 63,600.
Which is just a clean 50% haircut from that 126,000 peak we saw back in October.
It really is. It's a brutal drop. And our mission for you today is unpacking the roadmap of the one analyst who perfectly called this crash top to bottom.
Yeah, we're diving into the technical levels, the historical cycle data, and the macro wildcards that have him saying the bottom is still miles away.
Right, potentially plunging as low as 12,600.
It's a really sobering map to stare at.
Yeah.
But, whether you're managing a book of assets or you just watch the markets from the sidelines, understanding how a top-tier technician maps out human psychology on a price chart, it gives you a serious edge.
Oh, definitely. You're essentially looking at a real-time heat map of global risk appetite.
Exactly. It shows you visually where the heaviest concentrations of institutional fear and greed are just parked.
But the narrative on the floor this week feels wildly disconnected from that fear. So we need to ground this in the immediate price action.
Yeah, let's look at today.
So Bitcoin tagged 64,300 in today's session before fading back to 63,600. But the dominant headline is this recent 9% bounce off the June 5th low of 59,000.
Which, sounds good on paper.
Right. Bouncing 9% in a single week sounds objectively like relief for anyone holding long exposure. So why is this analyst treating a solid 9% push as a complete trap?
Well, context on a trading desk is everything, right? A 9% move in a vacuum doesn't magically erase structural damage. To understand why he's actively fading this rally, you have to look at the mechanics of the order book. The market just surrendered half its value in 8 months. When an asset drops that aggressively, it leaves behind this massive liquidity vacuum. What traders call air above the current price.
I hear that term air thrown around a lot.
Yeah. Right now, there is essentially empty air all the way up to 65,000, maybe even 67,000.
But wait, a lack of historical trading volume in that 65,000 to 67,000 zone means there isn't a lot of overhead supply waiting to sell, right? Like, less resistance should theoretically make it easier for the price to squeeze higher. Why is that inherently bearish?
It does make it easier to squeeze higher, but it makes the move entirely hollow. Think about what happens when you fall through a frozen lake.
Oh, man.
When you swim back up, you might hit a pocket of empty air, but you're still trapped under the ice.
Oh, wow, yeah. You aren't safe just because you can breathe for a second.
Exactly.
Yeah.
The analyst is pointing out that because the volume in this pocket is so incredibly thin, large players, institutional desks, whales, they're using these low-volume retail pushes as prime exit liquidity.
They're selling their remaining bags right into the rally.
Yep. If you watch the hourly momentum divergences, the buying pressure is visibly decaying even as the price ticks up. The conviction just isn't there.
So the short-term day traders are getting chopped up in the noise, trying to trade a bear flag that looks like a recovery.
Right.
But if we pull back from those hourly fakeouts and look at the daily data, the psychological exhaustion of the longer-term holders becomes glaringly obvious.
200-day moving average.
Exactly. It's looming way overhead at 78,000. And what really anchors this analyst's bearish thesis is that the price rallied directly into that 78,000 line last month and was just violently rejected.
Yeah, that was brutal.
And meanwhile, the faster moving averages, so the 10-day, the 20-day, the 50-day, they're all stacked in a bearish formation, pointing down like a collapsing roof.
And that 200-day moving average at 78,000 is critical to understand because it's not just, a mathematical line on a screen. It's the ultimate psychological break-even point. Well, it tells you the average price paid by investors over the last roughly 8 months. So when the market finally struggled back up to 78,000 last month, an entire cohort of underwater buyers collectively exhaled.
They realized they could finally get out without taking a massive loss.
Exactly. And they dumped their positions. It was a textbook liquidity event. Now, with the 10, 20, and 50-day averages all stacked below the 200-day, the market is basically communicating that its short-term memory is deteriorating.
Meaning sellers aren't holding out for 78,000 anymore.
Right. They're capitulating at lower and lower prices just to escape the volatility.
Which feeds directly into his specific wave count model. For you listeners tracking the structural cycles, this analyst argues that the entire brutal cascade since the October peak of 126,000 is merely the first major leg down.
Just the first one.
Yeah, he models this current 9% June bounce as just a fourth wave breather. He's tracking a massive head and shoulders breakdown, pointing toward a measured downside target in the 26,000 to 27,000 range.
It's aggressive.
It is. Listening to this wave count, it sounds exactly like a multi-act tragedy at a theater. The audience sees this June bounce, the house lights come up a fraction, and the retail crowd thinks it's the curtain call. Like, they survived, the play is over.
Right, they think they're safe.
But the analyst is standing at the back of the auditorium warning everyone that this is just the intermission. The final darkest act hasn't even started.
It's a dark intermission, that's for sure. And look, even if you view wave theory as little more than financial astrology, which, let's be honest, plenty of institutional quants do, you still have to respect this specific analyst's scoreboard.
Oh, completely.
He publicly called the 126,000 top. He anticipated the exact rejection of the 200-day moving average at 78,000. And he modeled out this June bounce 2 days before the price even hit 59,000.
Oh.
Yeah.
Yeah.
When a technician has their finger that firmly on the pulse of the market's microstructure, ignoring their worst-case scenario is just poor risk management.
So if the daily chart shows us that the short-term traders are getting trapped and exhausted, what does the psychology look like for the heavy hitters? If we zoom out to the weekly data, the tension is tightening like a piano wire.
It really is.
The 20-week moving average is sitting at 71,500. And to put that into historical context, the last major bear market rally managed a 46% rip before it rolled over. This current rally, it choked out at 38%, stalling exactly underneath that 20-week line.
The bulls simply couldn't find the momentum to push through. The overhead supply was just too dense.
And the analyst points to the weekly RSI, the Relative Strength Index, as the ultimate proof of that failing momentum. The RSI currently sits at 48.
Yep.
His entire apocalyptic roadmap requires that weekly RSI to remain strictly under the 50 level. I actually want to frame this for the listener using a car analogy, if that's all right.
Go for it.
If the RSI is the car's tachometer, measuring the engine's RPMs, and the 50 line is your cruising speed, an RSI of 48 means the bulls have the gas pedal pinned to the floorboards. The engine is absolutely screaming, redlining at maximum effort.
Well, because they can't cross that 50 line.
Exactly. It means the transmission is completely slipping, the engine is doing the work, but the tires aren't catching the asphalt. The price just won't move forward.
The transmission is entirely shot in this scenario.
Yeah.
And the tension on the trading floor right now is thick because the price is hovering dangerously close to invalidating his model.
Right.
A 12% move in price, pushing the RSI up a mere 3 points, would engage the gears and break his bearish thesis. But as long as the transmission keeps slipping, gravity takes over.
And if the bulls fail here, the chart opens up to massive historical downside magnets. We're looking at the 200-week moving average at 62,000 and the 300-week moving average way down at 54,000.
It's a long way down.
It is. And with the current price at 63,600, the market is standing directly on top of the 200-week battlefield as we speak.
Historically, those long-term weekly averages are the absolute bedrocks of the asset class. I mean, the pandemic liquidity crisis bottomed squarely at the 300-week line. The 2022 bear market bottomed right in the channel between the 200 and 300-week.
We're standing on the precipice of structural support, but Analyst's predicted sequence from this point forward is incredibly predatory. How does he see the trapdoor opening?
Well, he models a sequence designed to basically extract maximum capital from early buyers. First, the current support at the 200-week moving average, that 62,000 level snaps under selling pressure.
Okay.
The price then violently magnetizes down to the 300-week moving average at 54,000. Now here is where the market mechanics get fascinating. When price tags 54,000, a massive cluster of algorithmic trading bots and institutional VWAP models are pre-programmed to buy that historical level.
They trigger automatically, front-running the human traders.
Exactly. This creates a sharp synthetic relief bounce. Human traders on the sidelines see this green candle, they assume the historical bottom is in, and they aggressively pile into long positions.
The bottom callers declare premature victory. They think the new bull run has officially kicked off.
Right. They get their relief bounce, which the analyst labels as a wave 2 in his sequence. And the second those retail traders are fully margined and exposed, the algorithmic buying program shuts off, the institutional bids vanish, and the real trapdoor opens. The market flushes straight through 54,000, liquidating everyone who just positioned themselves for new all-time highs.
Which drags us right into the historical abyss. The math here gets incredibly dark if you hold heavy long exposure. The Analyst's historical playbook highlights this really stubborn, repetitive reality. Bitcoin bear cycles have consistently ended 80 to 90% below their cycle top.
Yeah, you can't argue with historical data.
An 80% liquidation event from the 126,000 peak lands the price at exactly 25,000. That move would completely erase the last 3 years of wealth generation, dragging the market back to early 2023 valuation levels.
It's staggering.
And if the asset follows the historical 90% drawdown model, his final destination zone is 12,600.
Just letting that number breathe on a trading desk changes the temperature of the room. 12,600.
Even his so-called bull case scenario, where he assumes the cycle is structurally softer than historical norms and only suffers a 70% drawdown, lands the asset at 38,000. His most optimistic outcome is 38,000.
Yeah.
I have to push back on this, though. Is it possible these historical cycles are simply outdated? Like, as this asset class matures, as spot ETFs absorb supply and sovereign wealth funds enter the arena, the liquidity pool fundamentally thickens.
Right.
Doesn't that deeper institutional liquidity dampen the physics of the market, making a 90% crash near impossible today? Or is this analyst just running worst-case mathematical extrapolations to farm engagement in a slow market?
It's a really vital critique. Any quantitative analyst worth their salt is currently debating whether the volatility compression we've seen in recent years makes a 90% drop obsolete. Right. However, his counter-argument to the thick liquidity theory isn't based on chart patterns. It relies entirely on a macro wildcard that institutional liquidity can't easily absorb the geopolitical landscape, specifically the unraveling of the Iran deal.
Okay, and strictly looking at this through the lens of market mechanics and global liquidity setting, all political bias aside entirely, the global equities markets spent the better part of the past week pricing in a de-escalation based on a reported handshake.
Yep. Yeah.
But this analyst, and perhaps more tellingly, the global crude oil markets, are aggressively fading the peace narrative.
You don't need a political compass to read the tape. You just need to watch where the smart money is parking their capital. The reality on the commodity floors is that crude oil remains heavily bid. The price of energy is staying sticky and expensive.
Which tells a totally different story.
It's exactly. Tehran is publicly denying that any private agreements were codified. And unfortunately, kinetic strikes in the region have resumed. The analyst's read, which is backed by the energy futures market, is that these diplomatic talks were merely a stalling tactic, and the market is about to wake up to a massive geopolitical mispricing.
And the mechanical translation of an oil shock into the crypto markets is an absolute wrecking ball for liquidity.
Oh, completely.
If this geopolitical framework fractures, crude oil spikes. High energy prices feed directly into global inflation metrics, which completely corners central banks.
They're forced to hold interest rates higher for longer to fight the inflation.
Right, which systematically drains the cheap fiat liquidity that speculative, high beta risk assets absolutely rely on. A geopolitical shock sends a volatility spike straight into the heart of an already bleeding order book.
The transmission mechanism is brutal and highly correlated. You don't have to predict what the diplomatic headlines will say tomorrow. You just have to know which direction the liquidity flows if the macroeconomic environment abruptly tightens.
Risk-off means capital flees to the dollar, not to volatile assets hovering over an empty order book.
Exactly.
Yeah.
But no predictive model, no matter how robust the macro or technical confluence, is foolproof. The hallmark of a professional trader isn't just slapping some sensational target on a chart. It's explicitly defining the exact parameters where their thesis is proven wrong.
And that brings us to his kill switch.
Yeah, the kill switch is the most intellectually honest component of his entire brief. He gives his clients two highly specific, actionable signals that, if triggered, entirely invalidate the bear market doomsday scenario.
What are they?
First, the price of Bitcoin must strongly reclaim that 20-week moving average at 71,500. Second, the weekly RSI must push out of its stall and cross back above that neutral 50 line.
So if both the price action and the momentum indicators flip simultaneously, the bearish sequence is shattered.
Yep. The roadmap to 12,600 is completely scrapped.
The transmission catches the gear, the tires grip the road, and the bulls drive away. It's a clean, emotionless invalidation. You don't need to overanalyze the headlines, and you don't need to guess how institutional desks are feeling on any given Tuesday.
Right. You just watch the tripwire at 71,500. If it snaps upward, the bears are forced to retreat and cover their shorts.
It's the essence of professional risk management. Charting isn't about predicting the future with absolute certainty. It's about mapping asymmetrical probabilities. The chart is simply telling you who is winning the war between capital inflows and outflows long before the financial news anchors figure out what happened.
Perfectly said.
So, to wrap up this massive roadmap, we started by grounding ourselves in today's reality, June 12, 2026, with the tape parked at 63,600. We dissected the incredibly fragile volume floor hovering at 59,000.
We looked at the mechanics of the 54,000 magnet where algorithmic bots are waiting to trigger a fake-out rally.
Right, and the historical abyss that targets an unthinkable 12,600. And finally, we locked in on the 71,500 kill switch that cancels the apocalypse entirely. Keep in mind, identifying these structural levels is an exercise in managing downside exposure, not financial advice to buy or sell any asset.
The levels dictate the behavior, not the other way around.
But looking at this entire sequence through the lens of algorithmic behavior leaves me with a lingering, slightly unnerving question for you to mull over. We established that technical analysis is fundamentally a visual map of human emotion.
Right.
It highlights the exact psychological levels where exhausted, overleveraged traders simply capitulate and sell. But as we just noted with the 54,000 magnet, these markets are increasingly dominated by high-frequency algorithmic bots and institutional VWAP programs.
Yeah, they are.
And machines don't feel fear. They don't panic sell at structural support. So if the vast majority of capital flowing through these charts is controlled by algorithms that are programmed to read these exact same moving averages, and RSI levels do historical targets like 12,600 just become self-fulfilling mathematical prophecies.
That's the million-dollar question.
Or will the machines, devoid of human terror and greed, eventually rewrite the market playbook entirely, rendering an 80% psychological drawdown completely obsolete? Next time you watch a critical level break on a chart, ask yourself, are you tracking human psychology or are you just watching the machines talk to each other?